Welcome to ACCA Academy YouTube channel. In this lecture, I want to examine interlocking accounting system or non-integrated accounting system. If you are coming across my lecture for the first time, please like the video, share it with others, and subscribe so that you don't miss my upcoming videos. If you are a returning subscriber, thanks for being part of this channel. So, interlocking system or non-integrated accounting system. This is the accounting system in which the financial accounts and the cost accounts are kept separately and independently of each other, but are reconciled on a regular basis. Interlocking is an accounting system in which financial accounts separately and independently of each other, but are reconciled on a regular basis. An accounting system in which financial accounts and the cost accounts are kept separately and independently of each other, but are reconciled on a regular basis. Where cost accounts and financial accounts are kept separately, the two will report different profit figures. Where cost accounting department is kept separately from the financial accounting department, the profits reported by the financial accounting may not be the same with the one reported by the cost accounting due to some of the reasons I'm about to look at. Causes of difference in profits. Causes of differences in financial accounting profit. Causes of differences in financial accounting profit and cost accounting profit. Number one, I want to look at appropriation of profit not dealt with in the cost accounting. Appropriation of profits not dealt with in cost accounting. The word appropriation in accounting means distribution. Appropriation of profit means distribution of profits. So meaning that these items may be considered in financial accounting, but they may not be considered in cost accounting. So if they are charged in financial accounting and not charged in cost accounting, that means they will make the profit reported in financial accounting to be lower. So since they will make the financial accounting profit to be lower, if you are now starting with profit as per financial accounting, these items will need to be added. You are going to add it when starting with financial accounting profit. If you are starting with financial accounting profit, these items will need to be added. But if you are starting with cost accounting profit, this item will need to be subtracted. Those appropriation items include number one, corporation tax. Corporation tax. If this has been dealt with in financial accounting, not considered in cost accounting, that means you will need to add it. Number two, transfer to reserves. Transfer to reserves. If transfers are made from financial accounting profit to reserves, so it will make financial accounting profit to be lower. So you add if you are starting with financial accounting profit. Number three, dividend paid or proposed. If this has been charged or proposed, dividend paid or proposed. If this has been charged in financial accounting, not considered in the cost accounting, to make the cost accounting, a financial accounting profit to be lower. So you add when you are starting with financial accounting profit. Then amount written off of goodwill. Amount written off of goodwill or preliminary expenses. All these items which have led to reduction in financial accounting profits but not considered in the cost accounting, you are going to add this. Then if you have provisions in accordance with IAS 37, provision IAS 37, this might be considered in financial accounting but not used in the cost accounting. So if it is not considered in cost accounting, you add it when you are starting with financial accounting profit. But if you are starting with cost accounting profit, this item will need to be subtracted. That is number one. Items whose costing treatment differs from financial accounting. The treatment in cost accounting may be different from that of financial accounting. One, you have stocks valuation. Stocks valuation. Cost accounting might use unit of output to value their stocks, while financial accounting might use reducing balance method or straight line method. As a result of that, the stocks reported in cost accounting may be different from that of the financial accounting. So where that is the case. So remember, this format is when you are starting with profit as per financial accounting. That is when you will need this adjustment this way. But if you are starting with profit as per cost accounting, the reverse will be the case. So profit, now we have opening stocks. Opening stocks. Remember, the normal format for calculating cost of sales is opening inventory or opening stocks, add purchases minus closing stocks. Where the opening stocks is higher. The higher the opening stocks mean, the higher the cost of sales. And where cost of sales is very high, the gross profit will be low. So you can say there is an increase in opening stocks where financial accounting opening stocks is greater than cost accounting opening stocks. So because you are comparing financial accounting information with cost accounting information when you are starting with profit as per financial accounting. But if you are starting with profit as per cost accounting, you'll be comparing the cost accounting information against the financial accounting. So opposite will be the case. So now if the opening stocks in financial accounting, if it is greater than the opening stocks in cost accounting, since you are starting with profit as per financial accounting, in that case, you can see there is an increase in opening stocks. Increase in opening stocks means higher cost of sales. A higher cost of sales means lower profit. Since it means lower profit, you are going to add the increase in opening stocks. But where it is decrease, increase, decrease. Where it is decrease, you less. Number two, we have closing stocks. Closing stocks or closing inventories. The higher the closing stocks, the higher the profit. Remember, you normally deduct closing stocks from goods available for sales in order to get cost of goods sold. Where the closing stocks is higher, that means cost of goods sold will be lower since you are going to subtract the higher closing stocks. Cost of sales will be lower. And the lower cost of sales means the higher the profit. So an increase in closing stocks means higher the profit, as I've said. So where the closing stocks in financial accounting, where it is greater than the one reported by cost accounting, in financial accounting perspective, you say there is an increase in closing stocks. So increase in closing stocks means higher profit, so you are going to less it. Why decrease in closing stocks means lower profit, yes, lower profit. So you add. So they are opposite to each other. Add increase in opening stores, less decrease in closing stores. While you less the decrease, less increase in closing stores, add increase in closing stores. Plus, minus, minus, plus. So, but if you are looking at it, if you are starting with profit as per financial accounting, as per cost accounting, you'll be looking at it in cost accounting perspective, where the opening stores in cost accounting, where it is greater than the one reported by financial accounting. In the cost accounting point of view, that means you have increase in opening stores. That is where opening stores in cost accounting is greater than the one reported by financial accountant. You say there is an increase in opening stores in cost accounting perspective. I've told you that this format I'm giving to you is in the financial accounting perspective. That is, it is financial accounting perspective when you are starting with profit as per financial accounting. That is when you'll be looking at it this way. Number 2, then we have expenses. Expenses. The higher the expenses mean lower profit. Higher expenses mean lower profit. You know, you are going to subtract expenses from gross profit to get the net profit. Where your expenses is higher, that means the profit will be lower. Increase in expenses, if financial accounting expenses is greater than cost accounting expenses, in financial accounting perspective, so we can say there is an increase in expenses. Increase in expenses means lower profit, as I've said, so you are going to add. Then why decrease in expenses means higher profit, so you minus, you less it. Number 3, we have items not credited. There are a number of items that have been credited to financial accounting. Items not credited to cost accounting, profit or loss. So meaning that these items, they have been credited to financial accounting, but cost accounting did not credit them. That means this item will make financial accounting profit to be higher or greater than that of the cost accounting. So in that case, if you are starting with profit as per cost accounting, you are going to deduct those items. Items such as discount received, which have increased the profit as per financial accounting, rental income, which have increased the profit as per financial accounting, or rent receivable. Then we also have dividend received, which have been credited to profit or loss in financial accounting, or dividend or investment income. Investment income. These items have increased the profit in financial accounting. So when you are starting with profit as per financial accounting, you are going to less this item, you deduct these items. Then number 2, items not charged to cost account profit or loss. This item, they have not been deducted as an expense at all in the cost accounting. Items such as discount allowed, but they have been deducted in the financial accounting. That means they have reduced financial accounting profit. Discount allowed, then interest on loans or overdraft, the interest charge. These items have reduced the profit in financial accounting. Then provisions in accordance with IAS 37. Provisions, IAS 37. Penalty for late completion. Penalty for late completion of contract. Goodwill written off. Goodwill written off. Preliminary expenses written off. These items have been charged in financial accounting. Corporation tax. That means financial accounting profits have been reduced by these items, but they have not been charged in the cost accounting. So since they have not been charged, if you are starting with profit as per financial accounting, you are going to add these items. You add them. Format. So you may have XYZ Limited. Reconciliation of profit as per financial accounting with profit as per cost accounting. So you start with profit as per financial accounting. Supposing you are starting with profit as per financial accounting, I've told you you are going to look at it in the perspective of financial accounting. Number one, we add. So I've told you that an increase in opening inventory means increase in cost of sales and lower profit. So you add it. Increase in opening inventory. That is, if the financial accounting inventory is more than the cost accounting opening inventory. Then, for closing inventory, I've told you the higher the closing inventory, the higher the profit. So that means the decrease in closing inventory, decrease in closing inventory. Since you are starting with profit as per financial accounting, if the financial accounting profit is lower than the cost accounting profit, then you say the closing inventory reduces. Then the higher the expenses, the lower the profit. So increase in expenses. The higher the expenses, the lower the profit. Increase in expenses. That is, if expenses reported in financial accounting, since you are starting with profit as per financial accounting, if the expenses reported in financial accounting, if it is higher than the one reported by cost accounting, so you say there is an increase. Then you add this, you have the total. You now let these items. If you have your, let me include this. Discount allowed. Discount allowed. If it is charged in financial accounting, not charged in cost accounting, that means profit in as per financial accounting will be lower. You are going to add it back. Provisions. Provisions charged in financial accounting in accordance with IAS 37. If it is not charged in cost accounting, it will make the cost accounting profit to be higher than the financial accounting. That is, it will make the financial accounting profit to be lower. Then, goodwill written off. Goodwill written off. Where goodwill is written off in financial accounting, and if it is not considered in cost accounting, it will make the financial accounting profit to be lower. So you add it. Preliminary expenses written off. This will make financial accounting profit to be lower. So you add it. Then after adding all these items, if you have dividends, dividends that have been considered in financial accounting, not considered in cost accounting, dividend paid. So it will make financial accounting profits to be lower. Corporation tax. Corporation tax. If this has been considered in financial accounting, not considered in cost accounting, so you add it. So the sum of all these items, so we give you this. If you add this to profit as per financial accounting, you have this as the total. So you now list the following items. The items not credited, the pure financial matter. Item not credited in cost accounting, such as discount received, discount received. This has only been recognized by financial accounting. So it will make financial accounting profits to be higher, so you less it. Then rental income. rental income, or rent receivable, Since this will only be recognized by financial accounting, it will make profit in financial accounting to be higher, so you subtract that. Profit on sale of non-current assets. This will make financial accounting profit to be higher, since it will not be reported by cost accounting. So you are going to less this if you are starting with profit as per financial accounting. But if you are starting with profit as per cost accounting, reverse will be the case. Then after summing up this, then we have a decrease in opening stock, decrease in opening stocks. I've told you that you are going to look at it in the perspective of financial accounting. It is a decrease if financial accounting, the amount reported by financial accounting, if it is lower than the amount reported by the cost accounting. Then we also have a increase in closing stock, increase in closing stocks. If the amount reported in financial accounting is higher than the one reported in the cost accounting, so you say there is an increase, so you subtract. That is if you are starting with the profit as per the financial accounting. Then decrease in expenses. Decrease in expenses. If expenses reported in financial accounting, if it is lower than the one reported in the cost accounting, so you say there is a decrease. After summing up all this, you have this. Then you have profit as per cost accounting. This is when you are starting with the profit as per the financial accounting. If you are starting with the profit as per cost accounting, what I have added here will be subtracted, and what I have subtracted will be added. Reverse will be the case. Example, ICAN Limited trading profit and loss account for the period ended 31st January 2018 was as follows. At the debit side, we have purchases 150,000, closing stocks 12,750, total 137,250, direct wages 42,350, production expenses 9,720, selling costs 16,650, administrative expenses 13,580, depreciation 4,915, net profit 76,035. At the credit side, we have sales 75,000 units, amounted to 281,250. Discount received 2,500. Investment income of 16,750. Total of both the debit and credit sides is 300,500. The costing profit was only 61,985. You were, however, given the following additional pieces of information in respect of the accounts. 1. The cost accountant valued costing stock at 27,840. 2. Depreciation was valued by the cost accountant at 3,540. 3. Selling and administrative costs were valued at 10% of sales value and 0.24 naira per unit of sales in cost accounts. 4. Production expenses were valued by cost accountant as 5,090. You are required to reconcile the profit figures as reviewed by the two accounts. Now let's have the solution. I'm going to solve the question in two ways. The first method is when starting with the profit as per financial accounts. And the second method will be when starting with the profit as per cost account. So now we have the name of the entity, which is ICAN. ICAN Limited. Reconciliation reconciliation of financial accounting profit with the profit as per cost accounts. So we want to reconcile the financial accounting profit with the profit as per the cost accounts. So you are starting with profit as per financial accounting. Now back to the question. The profit as per financial accounting amounted to 76,035. We have 76,035. Then you add items not charged in financial accounting. Those items that were not used to reduce financial accounting profit, which ought to have led to the reduction in financial accounting profit. I mean, those things that have reduced the profit as per cost accounting, but we did not reduce the profit as per financial accounting. That is items not charged. Back to the question, note 1. The cost accountant valued costing stocks at 27,840. Now, remember, we are starting with the profit as per the financial accounting. Since you are starting with the profit as per financial accounting, then you are going to look at the financial accounting items against that of the cost accounting. You look at it in the perspective of the financial accounting. You look at the amount reported by the financial accounting against that of the cost accounting. Remember, the higher the closing stocks, the higher the profit. Now, compare the closing stocks as per financial accounting. We have 12,750. And how much was reported by that of the cost accounting? We have 27,840. The closing stocks of financial accounting is lower than that of the cost accounting. So the implication of this is that since the closing stocks is lower, the profit in the financial accounting will be lower. Well, why? No, I've told you the higher the closing stocks, the higher the profit. And the lower the closing stocks, the lower the profit. I've told you that the profit in the financial accounting will be lower since the closing stocks in the financial accounting is lower than that of the cost accounting. So, when the closing stock is lower, we used to deduct closing stock from goods available for sales in order to arrive at the cost of goods sold. If the closing stock is lower, if you deduct the closing stocks, that means the cost of goods sold will be higher. And when the cost of goods sold is higher, the gross profit will be lower. Now, since the closing stocks in financial accounting is lower, that means the profit in the financial accounting will be higher. So that shows that the financial accounting is reporting higher profit when compared with that of the cost accounting, since the closing stocks is lower. I've told you that the lower the closing stocks, the lower the profit. The higher the closing stocks, the higher the profit. So financial accounting is reporting lower profit. So we are going to add it in order to increase the profit as per financial accounting. So we have difference in closing stocks. Difference in closing stocks, which is 12,750, the one reported by financial accounting, minus how much is the closing stocks as reported by the cost accountant, 27,840. 27,840. So we have minus 27,840. How much is the difference? 12,750. 12,750 minus 27,840. So we have the difference of 15,090. I've told you we are adding this because the lower closing stocks reported by financial accounting means financial accounting is reporting lower profit. That is why we are adding it in order to increase it. Back to the note. You have depreciation was valued by the cost accountant at 3,540. You have to compare the depreciation reported by the financial accountant. Financial accounting. You compare with that of the cost accounting. Financial accounting reports higher depreciation. No, depreciation is an expense. The higher the expense, the lower the profit. So that is to show that since the depreciation reported by financial accounting, since it is lower, so that means the profit reported in financial accounting will equally be lower. So we are going to add the difference in depreciation. So difference in depreciation. So difference in depreciation. You are adding it in order to increase it. You want to increase the profit. So depreciation reported by financial accounting is 4,915. How much is reported by the cost accountant? So we have depreciation reported by the cost accountant to be 3,540. So we have minus 3,540. Depreciation is an expense. The higher the expenses, the lower the profit. We are adding it since the profit reported by financial accounting is lower. The reason why we are doing it that way is because you are starting with the profit as per the financial accounting. So 4,915 minus 3,540. So we have 1,375. Back to note 3. Selling and administration costs were valued at 10% of sales value and 0.24 per unit sales in cost account. So this is selling cost. Selling expenses is 10% of sales value. How much is 10% of sales value? This is the sales value, 281,250. If you calculate 10% of this, so financial accounting, how much is the selling cost reported? Selling cost. Financial accounting, then we have cost accounting. How much is the selling cost reported in financial accounting? 16,650. 16,650. How much is reported by cost accounting? 10% of sales value. And sales value is 281,250. That amounted to 28,125. So financial accounting reported lower selling costs. So the lower the expenses, the higher the profit. That means financial accounting is reporting higher profit figure as a result of the lower selling expenses. Since the profit reported by financial accounting is higher, you are going to subtract the difference in selling cost. So we are not going to add. Now, aside the selling cost, we also have the administrative expenses. Admin. How much is the administrative expenses? The one reported by financial accounting is 13,580. No, since you are starting with the profit, 13,580. Since we are starting with the profit as per financial accounting, that is why we are comparing financial accounting against that of the cost accounting. So, how much is the admin expenses? We were told is 0.24 per unit of sales. The number of units sold is 75,000. So, what is 0.24 times 75,000? 0.24 times 75,000. There you have 18,000. Financial accounting is equally reporting lower administrative expenses. Since the administrative expenses reported by the financial accountant is lower, that means the profit reported by the financial accountant will be higher. So as a result of that, you are going to subtract it. Anything that leads to higher profit, you subtract. And anything that leads to lower profit, you add. Now, back to the note 4. You have production expenses were valued by the court accountant as 5,090. How much is the production expenses reported by financial accountant? You have 9,720. So financial accounting reported higher production expenses. Higher production expenses reported by the financial accounting or financial accountant mean the lower the profit as per financial accounting. Since the profit as per financial accounting is lower by the difference in production cost, so you are going to add it. Financial accountant reports higher production expenses, which will lead to lower profit. So we add. So now, difference in production expenses. The one reported by financial accountant is 9,720 minus how much is reported by the cost accountant. We have 5,090. 5,090. 5,090. So 9,720 minus 5,090. So you have difference of 4,630. 4,630. So now if you go through the debit side, the only item that were not mentioned in additional information is direct wages and purchases. Since those items were not mentioned, that means the figure reported by the financial accounting is the same way the one reported by the cost accountant. So you don't need to adjust them. So we have items, we have pure financial matter or purely financial matter. If you look at this, these are items we said will be reported in the financial accounting alone, not in the cost accounting. Since dividend received and investment income will have led to increase in financial accounting profits, so we are going to subtract this in order to reduce the profit. So we have, now let's sum up, 15,090 plus 1,375 plus 4,630. So we have 21,095. 21,095. If you add it to 76,035 plus 76095, 035, 76,035. So you have 97,130. Then we less items credited to, let me just say, less pure financial matters or items credited to financial accounting, not reported by the cost accountant. So we have discount received of 2,500. We have investment income of 16,750. We are going to deduct them because they have led to increase. You know, these are income. They have led to increase in financial accounting profit. So, and they are not reported by the cost accountant. So you are going to subtract them. Discount received and investment income. So we have discount received, and that amounted to 2,500. You have investment income. Investment income of 16,750. 16,750. Aside this, let's go through the additional information to check those things we've not considered. Note 1, the cost accountant value costing stocks. We have dealt with the difference in closing stocks. That has been added. Depreciation, difference in depreciation has equally been added. Selling and administrative cost. We said selling. We said financial accounting reported selling cost of 16,650. And the selling cost reported by cost accounting is 28,125. So now we said the profit reported by financial accountant will be higher. So we are subtracting that. Difference in selling cost. The one reported by financial accountant is 16,650. Minus the amount reported by cost accountant, 10% of sales. That will be amounted to 28,125. 20,125. So what is the difference between that? 16,650 minus 28,125. We have for 11,475. Then we also have admin expenses. Difference in admin expenses. The administrative expenses reported by the financial accountant amounted to 13,580. 13,580. How much is the administrative expenses reported by the cost accounting? You were told it is 0.24 naira per unit of sales. Now let's calculate 0.24 times number of units sold. The number of units sold is 75,000 units. Now if you calculate 0.24 times 75,000 units, that will give you the admin expenses reported by the cost accountant. So we have 18,000. The administrative expenses reported by the cost accountant is 18,000. We said since the one reported by the financial accounting is lower, that will make the profit in the financial accounting to be higher. The expenses deducted by the financial accountant is lower. That means higher profit will be reported by the financial accountant. So we are subtracting that. Minus 13,580. The difference between this and this is 4,420. 4,420. So how much is the sum of all this? Plus 11,475 plus 16,750 plus 2,500, and that is totaled 35,145. If you subtract this from 97,130, so you have the difference of 61,985. That is the profit. Profit as per cost accounting. So it will give us the profit as per the cost accounting. If you check your question, so I think we are given the cost accounting profit. So we were told the costing profit was only 61,985, which agree with the result obtained. That is to show that our reconciliation is correct. Example 2. The profit shown in the financial accounts is 18,592 naira. And for the same period, the cost accounts showed a profit of 20,496. Comparison of the two sets of accounts reveal the following. You have cost accounts and financial accounts. Source valuations. Raw materials. Opening stocks. Cost accounts 6,821. Financial accounts 7,259. Closing stocks. Cost account 5,483. Financial accounts 5,128. Finished goods. Opening stocks. Cost accounts 13,291. Financial accounts 12,905. Closing stocks. Cost accounts 11,430. Financial accounts 11,131. Dividends and interest received of $552 naira, and a loss of 1,750 on the sale of a milling machine. were not entered in the cost accounts. You have to reconcile the profit figures. That is the question. Now, let's have the solution. This time around, I'm going to start with profit as per cost accounts. So I'm going to have reconciliation of profit as per cost accounts with the profit as per financial accounts. So this time around, we are going to start with the profit as per cost accounts. Profits as per cost accounts. You were told the profit shown in financial accounts is 18,592. This is profit as per financial account. And for the same period, cost accounts showed the profit of 20,496. The profit as per cost account is 20,496. So we are going to add items not credited to cost accounts. Items not credited to cost accounts. Items credited to financial accounts which were not credited to cost accounts. We have dividend and interest received of 552 and a loss of 1,750 on the sale of a milling machine were not entered in the cost accounts. These two items were not entered into cost accounts. So we have dividend received. Now this is an income, while this is a loss, a charge. So we are going to add this, while this will be subtracted. No, loss will lead to reduction in profit. And since it have not been deducted from cost accounting profit, we are going to subtract this. But this one, which was not credited as an income, we are going to add it. So dividend and interest, 552. So we have dividend and interest received. This is not dividend paid. This is dividend received. 552. You were told. Dividend and interest received. 552. Now, back to the question. You were given stocks valuation. These are stocks of raw materials, opening stocks of raw materials and closing stocks of raw materials. The opening stocks, I've told you that the higher the opening stocks, the higher the cost of sales and the lower the profit. The higher the opening stocks, the higher the cost of sales and the lower the profit. I've told you where there is an increase in opening stocks, that the profit, the cost of sales will increase and the profit will reduce. Increase in opening stocks, I've told you that will be added. So in this time around, if you look at the opening stocks as per cost accounting, it is lower than that of the financial accounting. Since you are starting with the profit as per cost accounting, you are going to be looking at cost accounting items against that of financial accounting. If you are starting with profit as per financial accounting, you'll be looking at financial accounting items against the profit, against the cost accounting items or transactions. But this time around, we'll be looking at those items or transactions in cost accounting. The cost accounting information, we'll be looking at cost accounting information against the financial accounting. So, the opening stocks of raw materials, cost accounting, we have 6,021. Financial accounting is 7,259. The cost accounting opening stocks is lower. Since it is lower, we are going to assume it is a decrease in opening stocks. I've told you that the lower the opening stocks, the lower the cost of sales. And the lower cost of sales mean the higher the profit. The higher the opening stocks, the higher the cost of sales, and the lower the profit. The higher the cost of sales, we know when you deduct cost of sales from goods from sales, you get the gross profit. So since the opening stocks is lower this time around, the one in cost accounting, it is a decrease in opening stocks. I've told you that we are looking at cost accounting against financial accounting, since we are starting with the profit as per cost account. So this is a decrease in opening stocks. Decrease in opening stocks means lower cost of sales, and lower cost of sales means higher profit. So since this leads to higher profit, we are going to subtract the decrease in opening stocks. Therefore, the closing stocks, the cost account is 5,483 and financial accounting is 5,128. The cost accounting opening stocks is higher than the closing stocks as per the financial accounting. So this is an increase in opening stocks, closing stocks. This is an increase in closing stocks. I've told you that the higher the closing stocks, the lower the cost of sales. And the lower the cost of sales, it means the higher the profit. The closing stock will be deducted from goods available for sales in order to get the cost of goods sold. Since the closing stocks that will be deducted now, this time around, is higher, that means the cost of goods sold or cost of sales as per cost accounting will be lower. And since you are having the lower cost of sales now, that means the profit as per cost accounting will be higher. So the higher the closing stock, the higher the profit. So since the profit as per cost accounting is higher now, you are going to subtract the increase in the closing stocks. Now, of raw material, we have for finished goods, the opening stocks, cost accounting 13,291, while financial accounting 12,905. The opening stocks of finished goods of cost accounting is higher. The higher the opening stocks mean higher cost of sales, and higher cost of sales mean lower gross profit. Since the gross profit is lower now, we are going to add the increase in opening stocks of finished goods. Now, let's have the add difference in opening stocks of finished goods. The one reported by cost accounting is 13,291 minus the one reported in financial accounting is 12,905. So the difference is 13,291 minus 12,905. So the difference is 386. 386. So we add the difference in opening stocks. I've told you there is an increase in opening stocks of finished goods because cost accounting, the amount reported in the cost accounting is higher than the one reported in the financial accounting. If you were starting with profit as per financial accounting, if you look at the opening stocks of financial accounting, since it is lower, we are going to assume it is a decrease in opening stocks of finished goods in financial accounting perspective. But in the cost accounting perspective, we'll be saying there is an increase because that of the cost accounting is higher than that of the financial accounting. So closing stocks of finished goods, financial accounting is higher than that of cost accounting. The higher the closing stocks, as I've said earlier, the lower the cost of sales and the higher the gross profit. So this one now, the increase in closing stocks means the higher profit, and the higher profit will be subtracted. So since it leads to an increase in profit, so we subtract it. So now, what is the sum of these two items? 552 plus 386. So we have 938. 938. So if you add it to 20,496, so we have 21,434. So we now less items not charged, or items charged whose costing treatment differs from that of the financial accounting. So this time around, we said we have decrease in opening stocks because the opening stocks in cost accounting is lesser. But if you are starting with profit as per financial accounting, you will have said there is an increase in opening stocks since the opening stocks of financial accounting is greater than the one reported by cost accountants. So, but in cost accounting perspective, you see there is a decrease. So, decrease in opening stocks, we are going to subtract it. So, difference in opening stocks of raw materials, the one reported in cost accounting is 6821 minus the one reported by financial accountants. We have 7259. So the difference is 6821 minus 7259. So you have 438. 438. Then the closing stocks also. We have the one reported by financial accounting is lower. So I've told you that the lower closing stocks mean lower profit. So the lower the closing stocks, okay, the closing stocks in financial account in cost accounting is greater. This is an increase in closing stocks. The greater the closing stocks, the greater the profit. So we subtract. So difference in closing stocks of raw materials. Cost accounting 5483, financial accounting 5128. So difference in closing stocks of raw materials, cost accounting 5483, financial accounting 5128. So the difference is 5483 minus 5128. You have the difference of 355. 355. Back to the question. Then we have closing stocks of finished goods. This is an increase also. Increase in closing stocks of finished goods mean the higher the profit. So we are going to subtract it. So difference in closing stocks of finished goods. The one reported by cost accounting is 11,430 minus 11,131 was reported in financial accounting. So you have the difference of 11,430 minus 11,131. 11,131. So you have 299. 299. Then we also have a loss of 1750 on sale of milling machine were not entered in the cost accounts. So loss on disposal. Loss on disposal. This is disposal of non-current asset of milling machine. And that amounted to 1,750. So if you sum up this 1,750 plus 299 plus 355 plus 438. So we have 438 plus 355 plus 299 plus 1,750. Then you have 2,842. If you subtract this from this total, from 21,434, so you have 18,592. This is profit as per financial accounting. I want to solve this same question, starting with the profit as per financial accounting. The first example also, you should also solve that one starting with the profit as per cost accounting and compare your reconciliation. So this is 18,592 and the profit as per financial accounting as given in the question is 18,592, which I agree with that. So this marks the end of the solution to this question. Please like the video, share it with others, and subscribe to the channel so that you don't miss my upcoming videos. Thanks for watching ACCA.